Hey, welcome back, folks. The Ray program, 844-RAY show. Stick around. I got an investor summit, the Accredited Investor Summit, coming up in Portland, Oregon on May 30th at the Hotel Monaco. All you need to do is go to accreditedinvestorsummit.com and get more information. We'll tell you more about that momentarily. But first, let me say hi to Lyn Rowe, certified financial planner. Did you hear me talking about the gator story?
I did.
Interesting. Have you seen that show, Strange Inheritance?
I have.
Very interesting show,
it is a
isn't it?
fascinating show.
So this particular case, you got 3 kids. One set of the kids is working with a husband and wife, I should say, working in the gator business. One guy loses a finger to some alligator.
Skin in the game, literally.
Definitely skin in the game. And the other 2 kids have nothing to do with the business, and they're fighting over the family fortune. Now, I know you as an advisor have been put in that situation before, but did you agree with my analysis of the whole situation?
Well, I was sitting there thinking life insurance is the obvious solution, because then you can allocate cash to the people who really don't want to be tied down to a business and give the business, if you will, to the children.
And what about the valuation aspect, where you value the company, giving the kids that have some skin in the game realistically a little bit higher ownership, et cetera, et cetera.
Sure.
Done that before.
Sure.
And it seems to work out very well. And then whether you used a second to die insurance policy or a first to die, depending on whether the husband or the wife would continue on and running the business after one spouse died, I think it's really the only way, unless there's a bunch of other cash assets that you can divvy up for the kids. But usually, and you know this,
business owners don't have cash. They are like making
even if
payroll,
they did,
they've got inventory, and they've got,
even if they did,
yeah.
Most business owners I know, like 90% of their net worth is tied up in that particular business, right?
Exactly.
That's also the reason why back in the day when we had, estate tax issues, we don't now with most businesses, but back in the day it was, the best solution to create liquidity upon death. Your business, the whole subject of insurance planning. I like how I segued into you being here today.
Wonderful. Thank you.
Okay. Now, the topic for my discussion, though, that I didn't get to last segment, 7 ways to destroy your wealth and guarantee you spend your life in poverty. It reminds me of Ben, Ben Stein, my good friend Ben. He wrote a book, How to Ruin Your Financial Life, some years back, and he would go on the speaking circuit. He and I were out on the speaking circuit, and one year that was what he would talk about.
Right.
This was before the economy went in the sewer, and we had the 2008 crash and all that stuff. So Ben's job was to go out and tell people how they were going to destroy their financial life in a fairly funny, humorous, but compelling way, and then I would do my thing. But this fellow, Joshua Keenan, wrote the following, and I just your comments. Trade as frequently as possible. We know that you shouldn't be an active trader. Build a portfolio of companies with PE ratios at least 3 times as high as the S&P. Yeah, you don't want to buy the sexy stuff.
.com.
Dot everything, or EI or whatever, EIEIO.
Yes.
Put together assets with tons of correlated risk. Buy Pepsi and Coke. Only buy stocks you don't understand. Buy shares with high accruals and lots of stock options. In other words, get diluted to nothing.
Yep.
Pay the maximum taxes and penalties as possible, and maximize your non-deductible debt. My suspicion is you have a couple of other ways to ruin your financial life.
Well, mine are more lifestyle type things rather than, the head financial type things. But the first one that comes to mind is divorce.
Is that why you never got married? To avoid the trials and tribulations of divorce?
We aren't going there, Ray.
Okay.
We aren't going.
Right.
But you've heard the horror stories. It just costs enormous sums of money to do this.
You hear this country song?
I do hear this.
DIVORCE. There's also been studies that have come out that say married couples live longer and live healthier lives.
Absolutely. In fact, insurance companies acknowledge that, because when you get long-term care insurance, for example, there is a marital discount. Why would they give them a marital discount? Well, part of the reason is they have a healthier life, and the participant, the primary participant in the caregiving next to that caregiver that's provided by the insurance company is oftentimes the spouse. The spouse is there to make sure everything's done properly, to give direction, to help out in the evenings, that kind of thing. So it increases the probability of that person living a healthy and longer life.
Now, when you got together with Terry and got my long-term care insurance some years back for Jeannie and I don't remember, what kind of a discount did we get?
Well, generally speaking, most carriers do 30%.
Wow, did I get that big of a discount?
Now, there's a carrier that if you are married, but only one of you applies, let's say one of you is uninsurable, you still can get the 15.
Really?
Yes, they acknowledge again that the life expectancy and the health of that individual are enhanced by having their spouse with them.
Okay, I was reading online about the partnership plans.
Yes.
And I wanted you to address that because every once in a while you have to remind me that the
works.
partnership plans are interesting, and they do enable individuals to keep a little more money to leave over for the kids. Since we're talking about Gatorama here, let's talk about Partnership Rama.
Sure. Well, the partnership plan, let's talk about the non-partnership plan first. The non-partnership plan basically says in most states that you have to, after you've exhausted the long-term care insurance and you start to use your own assets to pay for your care, assuming you still need care, you have to exhaust your assets down to $2,000 before you're eligible for any kind of public assistance, as in Medicaid. Well, with the partnership plan, let's say you've got a $200,000 pool of money in your partnership plan, and you've used up that policy. Well, then they say that you have to spend down to the $200,000 mark, and then they will participate. So you protect the same amount in assets, if you will, that you had in the plan.
So are most of the carriers that you work with involved in this so-called partnership?
Yes. The partnership, however, some carriers aren't, and it depends on the state. It truly depends on the state.
So let me see if I get this right. So this still happens, you still have to exhaust your long-term care insurance policy first.
Yes.
And then whatever amount that you exhausted or used, you get to maintain as assets, sacrosanct, if you will, to any Medicaid.
That's correct.
That's a pretty good deal. I mean, it's a way for you to preserve more assets for the kids. So it would seem to me that if you're going to buy long-term care, you'd want to have it coordinated with the partnership if it's at all possible.
Right. Now, there are hoops to jump through with each state. The hoops have to do with the level of benefits that you buy or the COLA that you get on the plan and so on. So you're not going to be able to buy the skinny mini plan and qualify for partnership.
All right. Well, skinny mini is not any language that we Italians and Sicilians understand. Now, if you said, the fat mama plan, with all due respect to Mother's Day and everything, we would understand that a little bit better. Stick around, because when we come back, I will be asking Lyn Rowe, why in the heck don't people buy this stuff? Why don't you buy long-term care insurance? She will answer that question, among many others, so don't go away. 844-RAY-SHOW is the number. We'll also clue you in on the Hotel Monaco breakfast. I was talking about the fat mamas and dadas. That'll be us at the Hotel Monaco with this phenomenal, omelet bar, scones, the whole deal. Don't go away. I'm making myself hungry here. One thing we talk about all the time in this program is making sure that in your portfolio you have so-called non-correlating investments. Because, well, let's face it, we talked about the cyclically adjusted price-to-earnings ratio last week being at very, very high ratios, 27 compared to an average of 16. That would portend that the market may not do as well as many would like it to do over the next decade or so. It's not a good short-term predictor, but it's been a very good long-term predictor of where the stock market goes from here. Of course, you've had Jeremy Grantham and many other billionaire money managers, not billionaire, but I don't know, he may be a billionaire for all I know, but I know he manages over $100 billion, and he seems to think so. So we want to have some assets in the portfolio that don't necessarily correlate with the high prices in stocks, and I dare say the high prices in bonds with interest rates at record lows, bonds trading at record highs. Where do you go from here? That's what the Accredited Investor Summit is all about. We're coming to Portland, Oregon on the 30th of this month, the 30th of May. Call 888-629-1299. We will feed you. Get your bellies full, because we're going to have about 3 hours of content that you're not going to want to miss. Non-correlating asset classes. Go to accreditedinvestorsummit.com, accreditedinvestorsummit.com, or just simply call 888-629-1299. Back with Lyn Rowe. Before the break, I asked you a question.
Yes.
Why in the heck don't people buy long-term care insurance, all right? Well, because I can only go back to my particular case. I still have bruises on my fanny from your little tiny size 4 shoes
years.
kicking me. And finally, I was talked into it, unfortunately not by you, but by my wife. Why don't people buy this stuff?
Well, Ray, I'll tell you, there are lots of reasons, and there are 5 that come to mind immediately, but the first one is we can't afford it.
Can't afford it, don't want to pay the money for it.
Yep, and what I try to get past this. When you go to buy a house, you have a budget. In fact, you get pre-qualified, so you have a budget. When you go to buy a car, you have a budget. So if it costs more than that, chances are you aren't going to buy a car.
But most people haven't budgeted long-term care into their budget.
But they can look at cash flow, or they can look at assets, and we can eyeball those and say, okay, this is safe money, we can set it aside, or we're going to pay off the car this month, or Social Security is going to start coming in 2 months, and we really don't need that cash flow right now, or whatever it is.
Here, you showed me something a week or 2 ago. There was a CD annuity that paid, like, over the next 6 years, it paid 3.1%. Then you showed me one that paid almost 2% over a 3-year period. So I'm sitting on a CD that's paying me 1/4 point for a year or 6 months, or a money market fund. Maybe I'm making 0.5%, and you can take it to 1.5%. I've got an extra 1% to spend.
And that was taxable, and this isn't.
Yeah, so you can, in fact, work with somebody, and I'm sure you do this, and just show them how to reposition assets, even in safe money accounts, that will potentially earn them more money, so they can afford to at least make room in a budget that they probably haven't made room for.
Why not let the interest on that money pay for the insurance?
Yeah, it's a good point. I also found an article here. I've got it here because I found it for you, and I haven't. Maybe I sent it to you. I'm not sure. Insurance swaps, another way to fund long-term care. It was in Financial Planning magazine. And there are now ways that individuals are saying, hey, you got this old life insurance policy you don't need. Why don't you just swap it out? Sell it to me being some hedge fund or some insurance guy. I like selling it to a public entity. And you can use that cash. You usually get 6 to 8 times the cash value out when you sell a policy as to or compared to when you might just surrender it. That's another pretty decent way to create the cash to be able to pay for long-term care.
Well, and that ties into another good point. There are actually plans where if care is imminent, someone is in care or they need care immediately, and they have life insurance, we can actually take that life insurance and turn it into a long-term care payout.
Yeah, absolutely. Now, the other thing is people saying, I'm going to self-insure. That's where I was for a number of years.
One of my very favorites.
I'll just self-insure. What do I care if it only costs $137,000 in Connecticut? I don't live there. I live in California. It costs $127,000. Well, whatever the number.
We've done the math on this, right? First of all, Fidelity already tells us that a couple over 65 can expect to spend about $250,000 on health care over and above their premiums for health care, over and above anything else out of their portfolio. So there's that off the table. Then if they spend equally as much or possibly more for long-term care, now you got $500,000 coming out of that portfolio. That's a chunk of change. And that's today's dollars. Let's inflate that. Let's just assume it's only 3% a year. Go out 20 years for the, say the 55-year-old, that's a chunk of change coming out of the portfolio.
Yeah, it could be in the 7 figures at some point.
Easily.
So self-insuring is not a good strategy.
It's not fiscally sound.
I'm never going to use it, Lyn. It's not going to happen to me.
I know.
It's going to be you.
It's the seatbelt theory. Why buckle if I'm not going to get in an accident? I get it.
Good point.
But the bottom line is that all couples over 65, 70% are going to need long-term care. 70. That's higher than any other thing you insure for today. And if you knew 70% chance that your portfolio was going to go down and you could buy insurance to protect it, wouldn't you do that? That's exactly what we're talking about. So with guys, you've got pretty good odds. Only 1 out of 2 of you is going to need it.
Here's something you'll never hear from me, but
Yes.
others have given me this excuse in the past.
Yes.
Well, I'll take care of her and she'll take care of me.
The I Love You Truly care plan. Yes. It's really, don't assume that when you become impaired or you're old enough to be feeble to need care, that she's going to be like staying where she was 20 years ago.
Or he, for that matter.
Or he.
Because he's going to croak and she's going to need long-term care,
And-
actuarially speaking.
Yep.
So it's the guy that's going to be stuck with taking care of the woman. How many of us are even qualified or capable of doing that? Come on.
I've known some really sad stories of guys who cared for their wives. One guy for 12 years.
Ooh.
Yeah.
I want to just have somebody. That's why I'm delighted to pay that, whatever it is, $4,000 a year that I'm paying for the two of us.
Yep.
I'm happy to pay it because I want to take care of my wife in different ways if she
Yes.
needs that care. And I sure as heck don't want her with the burden of having to lift me around, Mr.
And you don't
Fatso.
want to lose the relationship, because when you become the caregiver, you're no longer the husband or the wife. You're the caregiver. And
All
it's
right.
a whole different relationship.
The
Yes.
last one that I used to get is,
Yes.
I'll never die. I'll never need long-term care. People would actually say that. Nah, it's not going to happen to me for sure.
I don't plan on dying. That was my favorite. And that's true. We don't plan on those things. We don't plan on getting sick and we don't plan on dying. But you know what? They're inevitable. As Jean likes to say, we're all going to die and most of us are going to get sick beforehand. And that's just the bottom line. The question is for how long and for how serious. But assuming that for example, your family never needed care and you're going to continue that trend, that precludes accidents. What about accidents? And what about the fact that things like ALS and some of those things, you can't know. There's no history there. My brother had ALS, for Pete's sake, and no one in our family ever had ALS.
Yeah, you've had a couple of scary situations and unbelievably horrible situations, even in your own family, I'm sorry to say. But on a happier note,
Yes.
you sent me an email the other day that said something like yippee-ki-yay or whatever. I forget what you said. You had an individual that needed some kind of long-term care and couldn't get it because they
Yes.
didn't qualify.
Yes.
And you were able to help them. Can you explain that?
Well, and 70% of the claims going to insurance companies today are home care. People want to stay at home, and the insurance companies are delighted because they know they're going to get quality care, as we talked about before, because the spouse is going to be right there. So with that said, there are plans that will allow you to buy discounted hours of home care as opposed to discounted dollars of insurance plan, and you don't have to qualify for those.
That's incredible
It's
to
a
me.
wonderful plan.
What I feel really good about is these were long-time fans of the program.
Yes.
And they've met you
Yes.
through the show.
Yes.
And, for years, weren't able to really help them until these new plans have come out.
Yeah.
This is why you need to have a relationship with somebody that stays in touch with everything that's going on, because this plan that you presented then didn't even exist a few years ago.
That's right. That's right. More and more.
Yippee-ki-yay. If you want a yippee-ki-yay, go to iwantmyltc.net, and if nothing else, establish a friendly relationship with Lyn Rowe, because she stays on top of what's happening in this particular field. One of the few people I know in the entire country that stays on top of this extremely exciting area of financial planning that I spent no time educating myself on because I had Lyn. Yippee-ki-yay, or iwantmyltc.net. Thanks.